Hello and welcome to the latest installment of PwC's Basel IV channel. My name is Ryan Davis, and on behalf of the Basel IV team here at PwC, a big thank you for joining us today. Today's topic is SREP and Pillar 2 requirements, an important topic which is of course high on the agenda both of directly supervised SSM banks in the Eurozone, but indeed across all banks in Europe who are relevant to some sort of SREP review from their own national competent authorities. I'm joined today by another SREP and Pillar 2 expert to take you through today's topic in detail. We'll be presenting the slides together. But before I ask him to introduce himself, a few words about me. I'm a senior manager based in Frankfurt, where I'm part of both PwC's ECB office, but also hold a central role within PwC's EMEA Financial Services Advisory business, where I co-lead the Liquidity, Funding, and ILAAP business area. Within, I guess, a topic which is particularly relevant for SREP, given that it makes up one of the four key pillars of the supervisory review process. I'm joined today by Alexander Kottmann, who will assist me in taking you through today's topic in detail. Alex, welcome. Great to have you here for the session. Perhaps before we get into the detail and into the presentation, a few words about yourself.
Thank you, Ryan. My name is Alexander Kottmann. I'm a director in risk management banking here in Germany, based in Berlin, and I'm the subject matter expert for the supervisory review and evaluation process in Germany. I'm very much looking forward to lead you through this presentation today. And maybe to start off, we first have a look at the next slide, which is giving a status quo on the ECB's current risk assessment. And what is very important to bear in mind from my point of view is that this is the environment of the banking industry as seen by the ECB. So whatever assessment the ECB is performing for banks, this is always inside their heads, and this is always giving the frame. Looking into those issues the ECB currently sees in the banking industries, in the banking industry, there's a number to mention on the right-hand side. First of all, obviously, the ECB observes that the profitability in the banking industry is under pressure. This is related to the low interest environment, of course. But it's also related to the weak economic environment, and it is also related to the fact that banks are heavily dependent on net interest income. Another issue the ECB sees in many banks across Europe is high non-performing loan rates, which negatively affect the capital in some countries, especially in Southern Europe. Moving on to the next slide, and just to recall the functioning of the SREP and the different assessment areas the ECB and the national competent authorities are looking into. Certainly, we have not all the banks under the ECB supervision. It's only the larger banks which are under the ECB supervision. But as a matter of fact, the SREP per se is applicable to all banks across Europe, across the Eurozone. However, the ECB is still working on an SREP for less significant institutions. From the functioning and the methodology of the SREP, there are four different categories of assessment areas the ECB is looking into. First of all is the business model assessment. Second is governance and risk management. The third assessment category is the assessment of the capital risk. And the fourth assessment category is the assessment of risks to liquidity and funding. All of these assessment areas can be assessed with a mark ranging from 1 to 4. And depending on the score, that will then lead, for example, if we talk about risks to capital, in a higher capital assessment and in a higher capital SREP add-on. Furthermore, also in the liquidity area, the ECB and the supervisors may conclude that a bank will get some specific liquidity measures which they have to adhere to. Very important when the ECB and national competent authorities are looking into the banking sectors and are investigating one specific bank under the SREP is the key indicators. The ECB or other regulators haven't disclosed which indicators they are specifically looking at. However, from high-level point of view, the indicators is something the banks should look into themselves. And what is quite important is a number of indicators are quite obvious. For example, the EBA is publishing regularly its EBA risk dashboard with a number of indicators, and also there's the transparency exercise which is undertaken in a regular frequency. And there are also a number of indicators which are obviously at the heart of the interest of the supervisors. Also, from the supervisor's point of view, they would not only look at one bank specifically and on a standalone basis, they would always compare that bank to its peer group. From that angle, it is quite important that the supervised banks will have some idea what is their peer group and which other banks might be in their peer group, despite the fact that the ECB will not disclose the peer group to the bank itself. However, it is quite important that banks come up with their own estimate what a peer group might be and compare themselves to the other banks in that peer group. Moving on to the first category of the assessment of the SREP supervision, the business model analysis. The business model analysis will come to a conclusion about the viability and the sustainability of the business model of the supervised bank. Regarding the viability, this is a short-term horizon. The ECB or the supervisors will look into a time horizon of, let's say, a maximum of 12 months, and will look whether the bank will survive within that horizon. The sustainability of the business model has a long-term view, looking into a horizon of 3 to 5 years and looking into how sustainable the business model of that bank is. To do so, the supervisors will ask the bank to submit a number of different information to them. For example, the business strategy, but also the budgeting and the planning of that bank. And certainly enough, the information submitted by the bank will also be assessed in the wider business environment the banking industry is in, and certainly enough also comparing it again to the peer group of that bank. The second and another important assessment area of the supervisor is governance and control. And in governance and control, the supervisors look into how well the bank is governing, how well the bank is controlling, how well the bank is steering its risk. If you look into the different papers that were published by the regulators in the past, there's a number of different tools you would normally expect the bank to have around governance and control. Obviously, at the heart of interest of the regulators is the ICAAP and the ILAAP. There, of course, needs to be some stress testing framework. Interesting and crucial are IT systems, but there's also a link to recovery planning and compensation. And certainly enough, what the supervisors, the ECB, also looks into is the bank's risk culture and the bank's risk appetite framework. This would lead us to the next slide. because there has quite been a lot of interest around risk appetite, risk strategy, and business planning from the supervisory side. And if you say so, risk appetite is the starting point for a comprehensive ICAAP. Risk appetite is aligning risk to strategy, to the strategic goals of the bank, to capital and budget planning. Normally the risk appetite in the bank is determined by 3 different measures the bank should be undertaking. The first measure is to formulate a risk strategy with qualitative statements and objectives related to the risk taking. Then, as a second measure, the bank needs to implement ratios and indicators for different dimensions, for example, earnings, capital adequacy, and liquidity. The ratios and indicators would also align risk to the midterm budgeting of bank. And third dimension would be to determine risk limits for significant risk categories, for example, credit risk and market risk, and monitoring and adjusting the institution's risk-taking objectives according to these risk limits. This also is a tool to align risk to the midterm budgeting of the bank. The ICAAP is the governance tool that is important to harmonize governance and also the capital risks the bank is taking. And the ICAAP is not only consisting of methods to measure risks. The ICAAP should be seen in a more holistic, in a more comprehensive way. And it also comprises of governance tools and processes, and obviously there's also some stress testing which should be part of the ICAAP. What is very important to mention at this point for the ICAAP is the fact that the ICAAP currently is under review, and the ECB has articulated a number of changes, a number of ideas how the ICAAP will be changing going forward. And looking into those propositions going forward, possibly there will be 2 different perspectives related to the ICAAP. The first perspective is the economic internal perspective. The second perspective is the normative internal perspective. The economic internal perspective is the, let's say, ICAAP we know already. It's basically looking into all the risk categories, into all the risks the bank is taking and is exposed to, and that may have an impact on the regulatory capital or the capital side of the bank, and assessing the extent of that risk and how it may impact the capital of that bank. The normative internal perspective is more something like capital planning. The normative internal perspective should be forward-looking, should looking into the future not only for 1 year, but also for a period of at least 3 years. And it should combine both, let's say, a current basis, ongoing environment, as well as an adverse perspective. What is very important is that the normative perspective, the starting point would normally be a pillar 1 look into the different risk categories the bank is exposed to. But it should also be well connected to the economic internal perspective of the ICAAP, and additional risk categories identified that have a significant impact on the capital of the bank. These should also be taken into account into the normative internal perspective, and should also be accounted for if you look into the ICAAP into a forward-looking way. What is very important as regards the level of conservatism the ECB expects to apply on the ICAAP, this should also include unexpected and extremely rare losses. And one hint the ECB has given in the paper they issued is that this should be aligned to the IRRBB formula of the current Pillar 1 assessment. And if you look into the IRRBB formula, this has been calibrated on a confidence level of 99.9% and a holding period of a year. One of the most important risk categories when we look into the ICAAP and Pillar 2 is the interest rate in the banking book. And we see a lot of interest from the supervisors for the interest rate risk in the banking book recently. There have been a number of papers that have been published. The EBA has published its guidelines in 2015. Then the Basel Committee published a paper in 2016. And already the EBA has announced that the interest rate risk in the banking book again is under review, and they will possibly revise their guideline next year again, based also on the updated requirements from the Basel Committee, so the Basel paper from 2016. If we look into the Basel paper, there's a number of differences to the current environment. First of all, they give a number of parameters and assumptions how interest rate risk should be calculated, should be estimated. Also in the Basel paper you find some reports, some reporting templates regarding the regulatory reporting, both for qualitative and for quantitative information. And maybe the most important point in the Basel paper is some sort of regulatory tightening, because the regulatory threshold to identify an outlier bank has been reduced from 20% to 15%. So banks that calculate their Basel interest rate shock, they are furthermore regarded as an outlier bank if that is 15%.
Thanks, Alex. And it'll be up to me to spend a few moments now to take you through the last of the 4 pillars of the supervisory review and evaluation process, which is related to the adequacy of liquidity. And of course, the key tool or the key aspect that a supervisor focuses on when looking at the adequacy of a bank's liquidity is the ILAAP, or the internal liquidity and adequacy assessment process. Just 2 points that I'll make before we get into the detail of this. The first is to say, at least from an ECB perspective, for those banks that they directly supervise as part of the SSM, it's fair to say that from all the feedback that we get from the ECB, they have been quite disappointed up until now with the level of ILAAP or with the status of banks' ILAAP. It is definitely, in terms of what we see from the ECB, a key point of weakness that they see in terms of banks' risk management processes. And the second point that I would make as well is I suppose, almost despite all of that, while they do have the mandate to apply Pillar 2 liquidity requirements on banks, they haven't yet taken up that option. And I suppose all the feedback that we hear from the ECB is that is something that they would potentially consider into the future, but it's not something that they've done up until now anyway. And if we compare that to other supervisors, even within Europe, if we look at the PRA in the UK, they've taken a different approach where they do, on quite a regular basis, apply Pillar 2 requirements for liquidity on banks. So a couple of interesting points there. But in terms of the ILAAP itself, and in terms of the way that the supervisor looks at assessing the adequacy of a bank's liquidity, we can see here some of the key aspects of an ILAAP. A couple of points to make. The first is that the ECB and the EBA produced guidance toward the end of last year, and the EBA finalized their guidance on ILAAP towards the beginning of this year, which, especially the guidance for the ECB, was a little bit of a step change to what we'd seen in the past. There's a bit of a move away from this idea that an ILAAP should be a 100, 200-page document which describes what a bank does in terms of liquidity adequacy assessment and liquidity and funding risk management, to much more a demonstration to the supervisor of how liquidity and funding risk management is embedded within an organization's regular business processes. And I guess key to that is, which you see in the middle here, these liquidity assessment or liquidity adequacy statements. So instead of producing a big report describing all of these things, what the regulator, at least the ECB, requires now is more a short and sweet assessment or statement of the liquidity adequacy of an organization, no more than maybe 10 or 15 pages, and then supported by all of the documentation, reporting, so we can see down there at the bottom, daily, yearly, and even monthly reporting processes, such that they can see that liquidity adequacy is a key part of a business strategy, and that liquidity and funding risk management is well embedded in the organization's regular ongoing business processes. Moving on to the next page, going forward, of course, liquidity management will continue to be an important topic, an important process. In terms of, I mentioned before, the ECB at least has clearly stated to banks and even publicly that they are not particularly happy or not particularly satisfied with the level of ILAAPs and liquidity management across banks, at least up until now. And what we've got here, if we look at the key elements of the ILAAP, we put out three which are particular points of concern or particular points of focus, shall we say, from supervisors. And of course, then in turn, particular areas of focus of banks as well. The first around liquidity stress testing, and I guess what's key here, or the key feedback we hear from the supervisors, is that this should be consistent within the overall risk management framework. What do we mean by that? Well, where assumptions within your liquidity risk stress testing are similar to, for example, ICAAP stress testing processes, these should be consistent. There should be some sort of continuum around running liquidity risk stress testing processes from an ILAAP perspective and from a recovery and resolution planning perspective. So all these sorts of things should be consistent and aligned across the organization. I also wondered, within liquidity stress testing, the consideration of relevant dependencies, especially within different risk types. So has a bank within their liquidity stress testing processes considered all of their relevant liquidity risk drivers? And when we talk about liquidity risk drivers, we're talking about things such as outflow of deposits, outflow of wholesale funding programs, intraday liquidity risk, intragroup liquidity risk, these sorts of things. Are all of these risk drivers which are relevant for an institution being taken into account in liquidity stress testing processes? And of course, finally, the appropriate and effective integration of liquidity risk stress testing into overall risk management. So what is the link between liquidity risk stress testing processes and our assessment of our liquidity risk adequacy? The second point, which is a key focus, which we picked out here, is liquidity transfer pricing. And so how liquidity or the cost or the allocation of the costs and benefits of liquidity are integrated into a bank's overall funds transfer pricing system. And I think it's fair to say, well, both from supervisory guidance, but also from what we as PwC have been able to see in the market, this is definitely an area of improvement, or an area that could be much improved across banks in general. And here, I guess we picked out a couple of points here: consistency between governance and strategy. So how is the allocation of costs and benefits of liquidity driving the business strategy and driving the business? And the reasonable completeness of cost accounting. So how are we ensuring that that these costs are being taken into account? More a technical question, I suppose. How is these costs being taken into account in the internal transfer pricing processes? And finally, with regard to intraday liquidity risk management, again, this is the point that regulators seem to, and supervisors seem to focus on, ensuring that intraday liquidity risk management processes are well documented and are in place, that they're sufficiently detailed, and that they're relevant for the institution, but then also ensuring that there's an integration into the total liquidity and risk management framework. And a key link here, or I suppose a key gap that at least I see in the market, is ensuring that intraday liquidity risk management is adequately taken into account in the liquidity risk stress testing processes.
Thank you, Ryan. So, moving on, what is our experience from last year's ECB SREP, and what findings and points did we identify from the SREP letters we examined? Maybe first of all, it's interesting to have a look in the structure of an SREP letter. And maybe what is very important for you is we have a change in the SREP add-ons as compared to last year. In the 2015 SREP, there was only a CET1 ratio communicated to the banks. This year, or last year's SREP, came up with two different SREP ratios. There's the regulatory requirements, the P2R capital ratio, and there's the recommendation on capital in Pillar 2, which is the P2G, the Pillar 2 guidance. Also, you would find a number of qualitative findings in each and every SREP letter. A number of them Ryan already mentioned for the ILAAP. Much of that is quite similar to what we see in the ICAAP. Usual points the ECB would normally have, usual findings, would be findings around insufficient documentation, poor stress testing frameworks, poor, as assessed by the ECB, reporting templates, but also looking into the governance area. ICAAP and ILAAP is obviously at the heart of the interest of the ECB, of the regulators. Also regarding documentation of the ICAAP and the ILAAP, and the, let's say, philosophy of the ICAAP and the ILAAP, and last but not least also the forward-looking perspective of risk management. For banks, the most visible outcome of the SREP is the capital add-ons they receive from the supervisors. The, let's say, approach the ECB is taking when determining those capital add-ons is the Pillar 1 Plus approach. As a general matter, for the Pillar 1 Plus approach, the ICAAP on the one hand side is a starting point, so the regulators, the supervisors, would first look into the bank's ICAAP. They would then look into the risk profile of that bank as determined by the ICAAP, but they would also assess the quality of the ICAAP. They would compare this to the Pillar 1 risks of the bank, and then they would look and would try to find out if there are any other material risks beyond the Pillar 1 risks identified in the ICAAP, but also identified in other reviews the ECB has undertaken, and then looking into how high these additional risks are, and also, quite important, how well these additional risks are managed. And that would then lead to the SREP capital add-on for the base scenario. And if we also add the stress testing perspective to that, the stress testing would then lead to the Pillar 2 guidance capital requirements. Generally you can say P2R is more something for the baseline, and the P2G is more something related to the stress testing. Also quite important, the ECB is not taking into account any diversification effects between the individual risk categories. So different from what we see in most the ICAAPs that banks already have operating and established, where quite often diversification between risks are taken into account, and these diversification effects would lead to lower capital requirements. The ECB is always looking at the aggregated amount of the risks. Now, maybe it is quite interesting to briefly review on Pillar 2 requirement and Pillar 2 guidance and how these capital requirements in 2016 differ from what has been done by the ECB back in 2015. As I said, in 2015, the ECB would only determine a CET1 capital ratio for the bank. That changed in the SREP 2016, and banks would now receive two Pillar 2 capital add-ons. There's the Pillar 2 capital requirement, P2R, and there's the Pillar 2 recommendation, Pillar 2 guidance, which is P2G. The most important difference between capital requirement, P2R, and Pillar 2 guidance is that in phases of stress, banks are not necessarily obliged to adhere to the Pillar 2 guidance. So capital can fall below Pillar 2 guidance, and then banks after that stress phase are required to build up Pillar 2 guidance again. Also, Pillar 2 guidance can be offset against the capital conservation buffer. If a bank in a period of stress loses some capital, both the Pillar 2 guidance and the capital conservation buffer can act as a buffer to compensate those losses. Another important point to mention is that the minimum distributable amount is not affected by the Pillar 2 guidance, so the MDA restriction point is below the Pillar 2 guidance. Last but not least, the quality of capital to underlie both the Pillar 2 requirement and the Pillar 2 recommendation needs to be CET1 capital. This is quite different, for example, from what we see in other countries, like for example Germany, where so far the SREP add-ons follow the CRR's capital requirements, so banks can maintain capital according to the different capital components as we see it in the CRR. What is the entire capital banks are given in the SREP? What is the experience 2016? Overall, the capital requirements have been on a stable level from 2015 to 2016 as regards the SREP add-on. However, what we see is that there has been a shift, obviously, from P2R to P2G, which didn't exist back in 2015. Also, what we see, and I refer to the graph on the right-hand side of the slide, capital requirements increase by the score, and as a general rule of thumb, we can say that a worse assessment by one notch will lead to a higher capital requirement by approximately 1%. So the worse the ECB's assessment of the bank, the higher obviously the capital requirements. What we see on this slide is the aggregated results. If we move on to the next slide, we see the individual results as far as we know them. The ECB itself hasn't published a entire range of the capital surcharges they have imposed on the banks. So what we see on this slide is some PwC experience from looking into different SREP letters. And what we have seen so far is capital requirements, P2R capital requirements, ranging from 0.5% to 3.25%, and P2G capital requirements ranging from 1% to 2.5%. Obviously, and this is very important to bear in mind, this doesn't give the entire bandwidth of the ECB SREP capital add-ons, as obviously we have only looked into a small segment of the market. So P2R, we came up with the requirements based on a review of 21 banks, and for P2G we know the capital surcharge for 10 banks only. Maybe one point as regards the capital requirements we observe in Germany from the BaFin, these range between 0.25% to 6%, and the Pillar 2 guidance ranges from 0% to 3%, just to get an idea of the entire bandwidth the supervisors are using. And from that point of view, I'd like to move on to the ECB's priorities in 2017, and I'd like to hand over to Ryan.
Many thanks, Alex. So yes, to finish off this session on SREP and Pillar 2, wanted to finalize the presentation by talking about some of the ECB's key priorities into 2017 and beyond. And you can see here we've organized this across each of the 4 key pillars of the supervisory review and evaluation process as run by the ECB. Maybe to start off with, in the bottom right, in terms of the risk to capital, risk to liquidity funding, and this also touches on internal governance and controls, ICAAP and ILAAP. Of course, this is always a key part of the supervisory review and evaluation process from supervisors. I already mentioned before when we talked about liquidity and funding, with the new guidance from the ECB, a bit of a step change in terms of how the ILAAP at least should be presented. The same is also true of the ICAAP. And so key here is ensuring that capital management processes as well as liquidity management processes are well embedded within the organization, and that you're able to demonstrate this to the supervisor. Moving across to the bottom left, when we look at the risk to capital, I guess it's a big issue across banks in general, but also from a regulatory capital perspective, IFRS 9. And of course, with IFRS 9 rules coming into place as of 1st of January 2018, this will be a key issue going forward. Perhaps less so from a regulatory perspective, since the confirmation from the EBA that there would be a transitional period for regulatory impact to be taken into account in capital ratios. But still, of course, something that the bank should be taking into account, not least within their stress testing processes. And of course, the continued focus on non-performing loans and concentrations, and of course, this focus on non-performing loans is particularly true for those countries which have very high non-performing assets concentrations within those territories. And heading across the top, if we look in the top left around business model analysis, I always find business model analysis an interesting part of the SREP process. I guess it's something that hasn't, in the past, perhaps not traditionally been part of a supervisor's remit to look at the business model of a bank. But obviously what's quite clear here is that supervisors are not only interested in ensuring that banks hold sufficient capital and liquidity such that they can survive, such that they have adequate capital and liquidity in going concern situations, but they also want to test the viability of business models going forward through going concern situations. And so this is particularly important. And of course, the impact of Brexit. I mean, Brexit will impact on the business models of a number of banks across Europe, but also in the UK. So taking into account those impacts. And of course, competition from fintechs as well. We're seeing a bit of a change in the banking landscape, I suppose, with all of these fintech companies. So supervisors want to see how banks are planning or how banks are looking to respond to these challenges. And finally, in the top right, across internal governance and controls, a few things here, BCBS 239. Again, if we look at ECB feedback, I think it's fair to say that the ECB has been surprised with the progress that banks are making with BCBS 239. They would have expected more, at least that's what we hear from the supervisor. So these sorts of issues are taken into account in the SREP process and will continue to be reviewed going forward. TRIM, of course, the targeted review of internal models for those banks that use internal models for calculating Pillar 1 capital requirements. The outcome of TRIM will be taken into account in subsequent supervisory review and evaluation processes going forward. And for some banks, this could have a significant impact. And outsourcing. I guess this has been a hot topic on the ECB's radar for a couple of years now, ensuring that banks have documented processes for ensuring that outsourcing processes or that there's adequate risk management over key activities that are outsourced. So, given all of that, that brings us to the end of this PwC Basel IV session on SREP and Pillar 2. I, for one, enjoyed presenting, and I'm sure, well, I hope that you enjoyed listening to us as well. Special thanks to Alex for your time and for your expertise in explaining these aspects of the SREP. I found it extremely insightful, at least from my perspective. And just a reminder that if you have any questions or comments about today's session, then please do not hesitate either to get in touch with myself or Alex. Our contact details are there on the screen. Or alternatively, do get in touch with your relevant PwC contact. We'll only be more than happy to help. So many thanks again for joining us today. I trust you found a useful and relevant session, and we look forward to welcoming you to our next Basel IV channel session in the very near future. So goodbye for now.